There's a pension strategy that sounds smarter than it actually is. Advisors pitch it, retirees go for it, and more often than not, it's the surviving spouse who ends up with less than they expected, and no way to fix it. It's called pension maximization. And honestly, I get it. More money every month sounds smarter. Sounds like you're winning. And that's what I want to walk you through today, because the math looks clean at first, but there's a few places where this thing can quietly fall apart. And by the end of this, you'll understand why a simpler choice is sometimes the stronger one. So let's start with the actual decision. When you retire with a pension, you usually have to pick between two options. Option one, the life-only pension. This gives you the highest monthly payment, but when you die, it stops completely. So your spouse gets nothing. Option two, the joint and survivor pension. And this one pays less every month, but if you die first, your spouse keeps receiving income, usually 50% or 100% what you were getting, depending on what you elected. So right away, there's a trade-off. More income now or more security for your spouse later. And for a lot of couples, that's a real tension because the difference can be substantial. Let's say that you've got a couple, let's call them David and Carol. David's retiring at 62 with a pension. His life-only option is $3,200 a month. His joint and survivor option drops that to $2,400 a month. That's $800 less every month, almost $10,000 a year. Over 20 years, that's close to $200,000 in income that they gave up. That's real money. And when a financial advisor or insurance agent shows you that gap, it stings a little. So here's where pension maximization comes in. The pitch goes something like this. Take the higher pension, the $3,200, use part of that extra $800 every month to buy a life insurance policy on David. That way, if David dies first, Carol gets a tax-free death benefit. She takes that lump sum, invests it, or annuitizes it, and now she has income for the rest of her life. And on the surface, that sounds pretty smart. You keep more income now, you protect your spouse, you might even come out ahead. But here's the problem. This takes something guaranteed, a built-in survivor benefit from your pension, and replaces it with a plan that, well, has to work exactly right. Several assumptions have to line up perfectly. Several things have to go according to plan. And in life, they don't always. If you're finding this kind of breakdown helpful, go ahead and subscribe. This channel is all about the real life side of retirement, not just the numbers, but what actually happens when you get there. New videos every week. All right, so let's get back to David and Carol. David's 62, relatively healthy. He applies for life insurance policy, let's say a $400,000 death benefit, which is supposed to replace what Carol would have gotten from the joint pension. Now, $400,000 sounds like a lot, but here's the question that you have to ask. What does $400,000 actually produce in lifetime income for Carol? I mean, if Carol's 60 years old and she takes that $400,000 and buys an annuity, she might get somewhere around $1,800, maybe $2,000 a month, depending on the rates at the time. Whereas the joint pension would have paid her $2,400. So she's already behind. And that's if everything went according to plan. And here's where the assumptions start to matter. And this is where I want you to really pay attention. First, insurability. David has to qualify for life insurance. If he has health issues like diabetes, a heart condition, a history of anything significant, he may not qualify at a reasonable rate or at all. And if he can't get coverage, the entire strategy just collapses. There's no fallback. The joint pension election, it's already gone. You can't go back. And that's not a small risk. A lot of people at 62 have something health-wise going on, and the strategy never accounts for what happens if David gets declined. Second, the cost of coverage. So let's say David does qualify. He's paying, let's call it $500 a month for that policy. That eats into the extra $800 pretty quickly. Now he's netting maybe $300 a month more than the joint pension would have, which is something, but it's not the home run that it was advertised as. Now, here's something that a lot of people don't think about when they sign up for this. There are two main types of life insurance, term and permanent. And yeah, term is cheaper, but it only covers you for a set number of years, maybe 10 years, maybe 20. After that, it expires. And if David's still alive, there's no coverage. That policy is just gone. So Carol has nothing. Second is permanent insurance, like whole life. That doesn't expire, but it does cost significantly more. And here's the part that catches a lot of people off guard. Even with permanent insurance, the out-of-pocket cost, it doesn't stay the same forever. As David ages, the internal cost of keeping that coverage funded goes up. The insurance company's risk goes up. So over time, the premiums required to keep that policy in force can increase, and oftentimes significantly. What costs $500 a month at 62 might require $700 or $800 a month at 72 or 75. And if that becomes too expensive and David drops the policy, Carol has nothing. The whole strategy just disappears. And they spend, 10 years paying premiums with nothing to show for it? Okay, so this is where it gets really important. The joint and survivor pension isn't just a financial product. It's a guarantee. It doesn't care about the stock market. It doesn't care about interest rates. It doesn't expire. So Carol gets that check every month for as long as she lives, period. On the other hand, pension maximization replaces that with a chain of things that all have to work just right. David has to stay insurable, the premium has to stay affordable, the coverage has to stay in force. Carol has to successfully manage or convert that death benefit at exactly the right time, probably when she's grieving or overwhelmed. Now, you might be thinking, but what about the taxes? The death benefit is free, right? That's an advantage. And that's true. The death benefit itself is tax-free. But if Carol invests that money and pulls income from it, she's paying taxes on those gains. If she buys an annuity, a portion of each payment is taxable. Meanwhile, the joint pension payments, yeah, they're taxable too, but at least they're consistent, predictable, and don't require any sort of management. The tax advantage is real, but often overstated in the sales pitch. Let me give you another example. Different couple, different situation. Margaret and Tom. So Tom's a retired teacher. His pension offers $2,900 a month, life only, or $2,100 joint and survivor. He's in decent health at 64, so they go with pension maximization. He buys a whole life policy for about $600 a month. 3 years in, Tom gets diagnosed with early stage Parkinson's. The policy stays in force. Thankfully, they kept it. But here's what starts happening. With whole life insurance, the premiums don't always stay flat forever. As Tom ages and the internal costs of the policy increase, he starts getting notices that more premium is needed to keep the policy performing as projected. Suddenly, they're paying $750 a month instead of $600, then $800. So what felt manageable in year one is now squeezing their monthly budget in ways that they didn't plan for. They didn't make a terrible decision, but they made a complicated one. And complicated decisions have more places to go wrong. So here's the main takeaway. Pension maximization, it can work. There are cases where it does make sense. If David is significantly younger than Carol, if he's in excellent health and can lock in low premiums, if the income gap between the two pension options is small, or if they have other guaranteed income sources and the insurance is just supplemental, in those cases, maybe it deserves a real conversation. But it gets sold as a universal upgrade, a smarter move, and that framing is dangerous. Because for most couples, what they actually want is simple. They want to know that no matter what happens, no matter who dies first, that there's still income coming in consistently without having to manage anything. And the joint and survivor pension does exactly that. Pension maximization says, well, we can probably do better. And probably is a word that carries a lot of risk when you're talking about someone's retirement security. Look, I'm not here to tell you that one choice is always right. That's not how this works. Every situation is different. Every couple has different health, different income, different risk tolerance. But I will say this, when someone shows you a strategy that requires several things to go right over a 20 to 30 year period, and the downside is that your spouse runs out of income, that's not a reason to get excited, my friend. That's a reason to slow down and ask some hard questions. Questions like, what happens if you can't get insured? Or what happens if the premiums become unaffordable in 15 years? What happens if the projected returns don't materialize? And what happens if your spouse has to manage a lump sum loan at 75 while grieving? And those aren't pessimistic questions, they're just responsible ones. Look, the goal of retirement isn't to optimize every dollar. The goal is to build a life that you can count on. And sometimes the thing that feels like you're leaving money on the table is actually the thing that keeps you standing when things don't go as planned. Simple, guaranteed joint income might not feel as exciting as a strategy with a bunch of moving parts, but it lets you sleep. And in retirement, that matters more than most people admit before they get there. If this made you think differently about pension decisions, there's another video that I think that you'll want to watch next. It's about one wrong pension choice that can cost you hundreds of thousands of dollars, and how to actually decide which option is right for your situation. I'll leave a link down below. Remember, retirement isn't just a math problem. Thanks for watching, my friends. I'll see you in the next one.